Hey there, awesome accounting student. Mark Franke here. This video is for Accounting 100, Chapter 3. We're going to talk about debits and credits, the names of my two golden retrievers. So, we have so far just talked about the accounting equation. Assets equals liabilities plus equity. And we've been recording transactions in columns. And that works fine, but as the transaction volume increases, it will get too cumbersome. So we have a system that we use, and we have these two words called debit and credit. And the first thing you need to do is dispel any thoughts that you have about these two words, debit and credit, as meaning good or bad or up or down or whatever. Because to an accountant, debit means on the left and credit means on the right. And that's what they mean. Now, if you think about it this way also, you have 5 things in accounting, and on the screen is a little device that I've used over the years. In fact, this box I used when I took the CPA exam, and I would draw it out on a piece of scratch paper. When the exam would start, I wouldn't bring it in with me. That would be cheating. I brought it in my head, and then I put it on paper when I got the exam going. But there's 5 things in accounting: assets, liabilities, equity, revenue, and expense. Yeah, so if you think about this way, assets are debits, expenses are debits. But the main thing you need to think about is assets go up with a debit. So if I put the word debit, assets go up with a debit. If you remember that, you can fill out the rest of this form, because if they go up with a debit, they must go down with a credit. Assets go up with a debit. If you say that to yourself 100 times today, you'll never forget it. Assets go up with a debit. Assets go up with a debit. Now, when we jump over this equal sign, and I've designated the equal sign with this black line, it flips. It has to. Mechanically, it can't work any other way. So that means that liabilities go up with a credit. Liabilities go up with a credit. And equity goes up with a credit. Which means that they have to go down with a debit. So, assets go up with a debit, liabilities and equity go up with a credit. You've got to memorize that. So, if we think about revenue, revenue we know goes up, makes equity go up. Revenue makes equity go up. So, revenue is always going to be a credit. And therefore, expenses go up with a debit. So because expenses make equity go down, and equity goes down with a debit, expenses are always debits. So again, if you use these two, assets and expenses are debits, liabilities, equity, and revenue are credits. If that helps you a little bit. But we don't really need to worry about these revenue and expenses going down, because they really don't go down. So I'm going to just kind of gray out these two boxes here because they don't really go down. So in Canvas, in this link, I've given you this work paper. You should fill this out and have it available to you when you're doing the homework in Chapter 3. And we're going to use problem 3.4b and 3.5b as an example of how this works. So I've provided you with some T accounts, and let's look at that. Here is the T accounts. We have here a list of all of the accounts that are in our chart of accounts, and just keep in mind, always, debits are on the left, credits are on the right. That's why this T works so well in accounting, because we have a left and a right side. So debits are on the left, credits are on the right, every single time. So let's get started. We're going to record these transactions into the T accounts, and we have to always make sure that debits equal credits. Every transaction, we need two sides, at least two sides. We can have a compound entry, and we'll have some of those where we have three things, but it doesn't matter. We could have 10 accounts that are affected as long as debits equal credits. That's a key factor to this. Debits have to equal credits. So I'm going to designate the transactions that are listed in your book. This is on page 85, and they've listed these A through S. So we'll go through these one at a time and record them into the T accounts and then balance it out at the end. So the first transaction says, and this is Brian Carter, attorney at law. His business was started, and this is a brand new business. The first transaction says Brian Carter invested $150,000 in cash to start the business. So this money went into a bank account, and cash is going up. Cash is an asset. That is a debit. And then the other side of this is $150,000 into the capital account. We're going to label it A. Debits have to equal credits. So we debit cash and we credit capital. This is when the owner puts money into the business. Transaction B, paid $8,500 for the current month's rent. When we use the word paid, it means that cash went out the door, and we're going to record rent expense. So under rent expense on the debit side, expenses are always debits, and because cash went down, we're going to credit the cash account. This is transaction B. Transaction C, we bought a used automobile for the firm for $38,500 in cash. So we spent $38,500, cash is going down, and we have an automobile which is going up. This is transaction C. $38,500 is a debit to automobiles, and $38,500 is a credit to cash. Cash is going down, cash is an asset, assets go down with a credit. Assets go up with a debit. Transaction D, performs services for $21,500. Anytime you hear the word performed services, we're talking about revenue, because that's how we make money, is we perform services. And our revenue account is called fees income, and it's always going to be a credit, because revenue makes equity go up. It's always going to be a credit, and we got cash. So we put the money into the bank, and cash went up $21,500. Debit, cash, credit, fees, income. Transaction E says paid $1,850 for automobile repairs. Paid always means cash is going down. Automobile repairs is going to go under automobile expense. This is transaction E. It's $1,850. Debit automobile expenses and credit cash, $1,850. Cash is going down. We paid for some repairs on the automobile. Transaction F, performed services for $12,800 on credit. Performed services always means revenue. Our revenue account is fees income. But in this case, we didn't get paid now. We're going to get paid later. So this is on credit. Our debit is going to go to accounts receivable. Accounts receivable is an asset. Accounts receivable is going up. Accounts receivable is when our customers owe us money for work we've already performed. That's really important. We perform these services, we send them a bill, and now we're waiting to get paid. Transaction G, purchased office chairs for $6,500 on credit. So we bought some office furniture, which makes office furniture go up. These are chairs, $6,500, but we didn't pay cash for these. We told them we would pay them later. So we're going to put this into our liability account, accounts payable. Debit, office furniture. Credit, accounts payable. Accounts payable is a liability. Liabilities go up with a credit. H, received $6,500 from credit clients. So one of our customers paid us. Cash is going up. This is transaction H. $6,500 on the debit side of cash and $6,500 on the credit side of accounts receivable. Accounts receivable is going down. Why? The customers paid us. So yeehaw, we got the cash, it went into the bank. Transaction I, paid $4,200 to reduce the amount owed for the office chairs. So we made a payment to our vendor. We didn't buy any more chairs. We just made a payment. This is transaction I. So we're going to debit accounts payable for $4,200 and credit cash. Accounts payable is going down. It's a debit. And cash is going down. That's a credit. $4,200. Issued a check for $1610. This is transaction J. And because we paid cash, cash is going down, that's a credit. Debit utilities expense and credit cash. K, purchased office equipment for $22,800 and paid half of the amount in cash immediately. The balance is due in 30 days. Here's where we have a compound entry. We're going to have three pieces here because we didn't pay the whole thing in cash or the whole thing in credit. We split it up. So we have some office equipment. This is transaction K that we got, which is $22,800. Office equipment is an asset, goes up with a debit. And then we wrote a check for $11,400, which is half, and we have $11,400 that we're going to pay in the future. So we're going to debit office equipment for the total and then credit half of it to cash, $11,400, and the other half goes to accounts payable, $11,400. That's transaction K. Transaction L, issued a check for $18,900 to pay salaries. So we've got some salaries expense, $18,900. This is L. And because we wrote a check to our employees, $18,900 is coming out of the bank account. That's a credit to cash. Debit salary expense, $18,900. Credit cash, $18,900. Transaction M, perform services for $94.50 in cash. We've had one like this before. Anytime you see perform services, we're talking about fees income. Fees income is $94.50. This is transaction M. And we got cash. $94.50 is a debit to cash. Cash is going up. Fees income is revenue. It's going up with a credit. Transaction N, perform services for $6,500 on credit. This time We still have revenue. Anytime you see performed services, you're talking about revenue. $6,500, but we didn't get paid right now. We're going to get paid sometime in the future. Debit accounts receivable, $6,500. Credit fees income, $6,500. Oh, paid $1,076 for a monthly telephone bill. Anytime you see the word paid, it means cash went out the door. That is a credit to cash and a debit to the telephone expense. We paid the telephone expense, $1,076, that's a debit, and we credit cash. Cash is going down, cash is an asset, that is a credit to cash. P, collected $4,200 on accounts receivable from charge customers. So more of our customers paid us, and cash went up. $4,200 debit to cash, and we're going to reduce accounts receivable with a credit. Accounts receivable is an asset. It goes down with a credit. Our customers paid us. They don't owe us anymore. We purchased, this is Q, purchased additional office equipment and received a bill for $68.80 due in 30 days. We got some more office equipment. This is transaction Q. $68.80, and we're going to pay it later. So $68.80 is a credit to accounts payable. Debit office equipment. Office equipment is going up. Assets go up with a debit. Accounts payable is liability. It's going up. We're going to owe more money. $68.80. It's transaction Q. R, paid $900 in cash for gasoline. Man, that's a lot of gasoline. Purchased for the automobile during the month. This attorney must do a heck of a lot of driving. It could be like the Lincoln lawyer. Paid $900 in cash. Cash is going down. So that's a credit to cash. $900. This is transaction R. And we will debit automobile expense for the gasoline. And then the last transaction, S, the owner, Brian Carter, withdrew $8,000 in cash for personal use. Cash is going down. We wrote a check to the owner for a drawing. So we're going to debit the drawing, $8,000. The drawing makes equity go down. Therefore, it's always going to be a debit. Drawing acts like an expense. Although it's not an expense, it really relates just to the owner. So now what I can do is draw a line down here, and I'm going to use the border tool to put a line. We always want to draw a line when we're doing a math function, and I'm going to use EB for ending balance. So I'm going to add the debits, that's the positive side, and subtract the credits, that's the negative side. So I'm going to start, and I'm literally going to just add each one of the debit side and subtract each one of the credit side. And the balance in my cash account is $96,714. I'm going to do the same thing for every one of these T accounts and get a balance. And I'll be right back. Okay, so I have balanced out each one of the T accounts and have highlighted the ending balance in yellow so that it's easier for you to see this. Be a really good idea for you to balance out all your T accounts so that you have those numbers, and hopefully you can get the math right. The main thing is the cash account. It always is going to have the most transactions, but the ending balance for cash is a debit, accounts receivable is a debit, office furniture, office equipment, automobiles, those are debits. Those are all our assets. They're going to have a debit balance. Accounts payable, capital is credit. Fees income is a credit, and then the drawing and all the expenses are all debits. Okay, so that's enough for this one. My next video will take this and we'll prepare a trial balance and some financial statements. Look forward to that. Practice this over again, and I'll see you again next time. Bye-bye.